Thank you all for coming. Really appreciate it. This is a panel that I've wanted to do for a long time, and thanks to Michael Sidgmore, we've sort of pulled it together at very last minute, but I think it's a fascinating subject to understand the investing landscape on the West Coast and the East Coast in FinTech. Now tonight, Colleen has been kind enough to host us with the venue and the drinks, and she's just going to say a few words about Shepherd Mullen.
Hi everyone, thank you for coming out tonight. Welcome to Shepherd Mullen. We've been getting together with Pima on that in this group for just about a year now. I think we're coming up on 9 months. And really value the opportunity to get to know all of you and to have these wonderful panels. I'm here in the San Francisco office. I work in the finance area, and the FinTech overlap is with the capital markets and people kind of looking down the road for that securitization and thinking about that now when they're putting the products together. So that's how my practice area interacts with the FinTech space. So welcome. Without further ado, thank you.
Thanks, Colleen. And I'm going to introduce tonight our moderator with the most S, Tess Hatch from Bessemer. She's going to moderate this event, and she's going to let each investor introduce themselves, which is probably the easiest way. So over to Tess. Thank you. I don't know if there's something wrong with that, is there?
You just need to be
Unscrewed it.
Okay. Great. Well, thank you so much. Thank you all for attending tonight. And I'm just going to start it off with letting all of you introduce yourselves. So your investment focus, industries, geographies. I'll let you take it off, Alex. Thank you.
Hi, everyone. My name is Alex Davidov. I am an investor with a fund, early stage VC fund called Core Innovation Capital. We think about how do companies that make the world better for everyday people also create a whole lot of enterprise value for investors and for entrepreneurs. So we believe that those two things are very much aligned. In terms of focus areas, I'd say primarily it's FinTech. Although we do spend a ton of time on the periphery of that, so that could be things that intersect financial services like the future of work or health tech in many cases, and primarily seed and Series A. Geography-wise, we're U.S. focused, invest anywhere here. We have portfolio companies in New York, we have portfolio companies in San Francisco, at one in Austin, we have one in Portland, all over the country.
Hey everybody, Michael Gilroy. I'm an investor with Canaan Partners. We've raised $5 billion over 11 funds, been around since 1987. Invest across both tech and healthcare. On the tech side, pretty traditional tech fund from enterprise software, fintech, to consumer, to space, security infrastructure, although fintech is probably our single biggest vertical. We invested in Lending Club, Cardlytics, the first institutional round, in addition to companies like Instacart, Match.com. I personally invest in enterprise software at the application layer in addition to FinTech. From a geographic focus, we really invest anywhere the entrepreneurs are. So it's both international and within the US, primarily on the coasts, but everything in between as well. I'm on a board of a company called Bellhops in Chattanooga, Tennessee, and Cardlytics is in Atlanta as well.
Thanks, Mike. Hi, everyone. My name is Michael Sidgmore. I'm an investor with a firm called Broadhaven Capital Partners. We are kind of the traditional merchant bank. We have a FinTech investment bank that focuses on advisory and M&A at the top end of the market. It was founded by the former head of FinTech M&A at Goldman. And then we also have an early stage FinTech VC practice, which I run, where we invest mainly in enterprise and B2B focused FinTech businesses. So focus on capital markets, wealth management, especially finance and financial infrastructure focused businesses. So our view on FinTech, probably in part due to the fact that we work with many corporates, is that FinTech is really kind of the future of FinTech is about collaboration between incumbents and startups. There will be probably some direct-to-consumer winners, but much tougher to find that than it is to find FinTech companies that end up partnering. So we invest seed and Series A. Geographic focus is mainly U.S., although we'll invest in Europe, Israel, and we have a company in Mexico, which is a Mexican SMB lender. So some of the companies we invested in are Moneyline, Liveoak Technologies, it's a collaboration platform, Trizic, which is a white label digital advice workflow provider, and Credijusto, Mexican SMB lender.
Great, thank you so much. That's all incredibly impressive. And all of you guys do a lot of fintech in a variety of geographies, but let's jump right into the topic today of East versus West Coast. And I know we have two from East Coast or very recently moving to the West Coast and lots of time in New York. So what are the characteristics that define East versus West Coast fintech companies? Whoever wants to jump in.
So I'll share my perspective. I spent 14 years in New York, spent a year doing venture there, been doing venture here for 2 years. I think the differences in the gap in terms of what's going on is closing. So I think that was definitely maybe stronger 5 years ago. I think now there's much less of a difference for a number of different reasons. But I would still characterize like at a high level, if you're just talking about the proximity of customers and the types of talent that you have, you're going to see a lot more Wall Street focused businesses on the East Coast, and that makes a lot of sense. You have all your customers right there. On the West Coast, you're still going to see much more consumer focused. You're going to have more of that, consumer app talent, and I think in some ways there's also a whole other layer of what are the ecosystems like outside of fintech that are still different and evolving. New York is just still much more tight knit, where it's much friendlier, it's a little less competitive, although it's becoming more so. It's a little bit of we're all in this together helping grow this, and I think that's true here, but there's just a lot of people, and it's becoming a little bit more competitive rather than just collaborative.
Sure. So the first difference I want to point out is with the investor base, and that I think on the East Coast we do diligence, whereas on the West Coast you guys don't do diligence.
That's absolutely true. No diligence for us.
But in all seriousness, I think Alex is spot on. I used to really try and break it down by sector, and there's a lot of capital markets businesses in New York, and there are a lot of consumer in California, and I still think that's the case on average, but you do have a couple of really large consumer businesses in New York that have really kind of dominated at least the fundraising landscape with Betterment and Lemonade as of late. And then you have a lot of capital markets businesses, Trimid, IEX, Orchard, so on and so forth. But I do think the talent is the biggest one that Alex also touched on. And really what we like to see is a hybrid of the two, right? You have a lot of tech on the West Coast, and you have a lot of fin with the capital markets and Wall Street experience on the East Coast. If you can bring those together, I think that's really the best team you can have in fintech.
So I have a little bit of background. I've worked in startups. I was the first sales hire at Mosaic, which is a solar lending platform out here in Oakland, and I've built a sales team at a company called iCapital Network, which is a tech-enabled feeder fund platform in New York that gives high net worth community access to private equity funds and hedge funds. So I've kind of seen it from both sides, and now on the VC side from both sides. I to be honest, I couldn't decide whether to wear my hoodie or or wear my suit, so I went with neither. No, joking aside, I mean, I think I've noticed two things about the differences between the New York and the San Francisco scene. So one is to do with tech talent, and I can kind of speak from experience at iCapital. We were building more of a B2B business at iCapital and a B2B2C business, but it was relatively hard to find high quality tech talent. I think harder than it is to find that here. I think in large part that's due to the banks and the fact that developers get paid pretty well there, and it's hard to leave a job to get paid pretty well in an expensive city. So I think kind of one of the differences I've seen is with tech talent. It's just harder to hire than our market. The good fintech companies will be able to find people, but we, I think that was one of the things we always found more challenging. And then I think the other piece of it too is New York has more fin, San Francisco has more tech. So if you want to find people who are good, product specialists or salespeople for financial products, New York is probably the right place to go because you're going to get a ton of people out of banks or hedge funds or private equity firms who understand financial products, sold financial products, et cetera. So I think it's easier to find people like that there. Whereas San Francisco, I think for the most part, you have a lot more consumer-facing businesses that have done well. Although I think Betterment, Stash, Lemonade, New York's starting to have a little bit of that. But for the most part, I think those are two kind of high-level differences that make for, I think, New York more of a B2B fintech town and San Francisco more of a B2C fintech town.
I just want to add to your point about tech talent because I think it's a really interesting and important point. I think there's a lot of nuances there, and from our experience, you definitely have certainly the universe of capable engineers in San Francisco is larger, and I think no question. But you sort of have to weigh that against the competition, and so I think engineers, there's obviously we all know how much demand there is for engineering talent. So if you're going to build a fintech business, make sure you're able to attract great engineers. A lot of fintech companies. Some are very tech focused, and some are really financial services with some tech backend. And those are going to be harder businesses to attract great talent to when tech isn't driving the business. And so you might actually have a harder time here. Second piece here is the churn rate of engineers is incredibly high. So I've heard of stories where, once the CTO accepted an offer, the CEO took him out to dinner multiple times just to make sure he didn't then back out of it before he actually joined. Like that is the kind of stuff that happens here. It doesn't happen as much on the East Coast. I think you tend to see people stay with their companies a little bit longer. Part of that is a cultural thing potentially. Part of that is just less opportunity. So you kind of are trying to always try to trade those things off. You may actually find that you're better off building a tech team somewhere else entirely, given what you need for your fintech business.
So summarizing a few of the things, Michael, you said, Fin on East Coast, tech on the West Coast, and both Michael's were commerce West Coast, and then Wall Street on the East Coast. Can you break a little bit more detail into the subcategories of each of those and where you see on each geographical region within a high level to a more deeper overview?
So you mean in terms of like the kind of the areas within fintech, like whether it's asset management or wealth management, things like that? Yeah. So I'll give you perspective from the areas we focus on, which are capital markets, wealth management, especially finance, and financial infrastructure. So I think we focus on B2B businesses. So I think I'll probably have a little more bias towards that side of the world, which we found. Generally speaking, more of those companies coming from New York. Although I will tell you one thing, I don't want to miss out on the flyover states. We've actually found some interesting tech talent and interesting companies in other places like Austin. One of our portfolio companies in Austin, a company called Liveoak, which is a collaboration software that enables people to enterprises and their clients to complete complex transactions remotely and in a compliant way. So you don't have to be in either New York or SF to build an interesting business that then sells their product to New York, financial institutions. But I think, generally speaking, you're going to see them in the capital market space. A bunch of the companies you mentioned, TrueBit, et cetera, PureIQ, DVO1, a lot of deep capital markets business. I think you'll generally find in New York, just because a lot of those people have rolled out of banks. I mean, if you're building a data and analytics business for the marketplace lending space, like an Orchard, like a PureIQ, like a DVO1, somebody probably rolled out of a bank and was on a structured credit desk or something like that. You're more likely going to find that in New York than you are in SF. Now, having said that, I think especially finance, the consumer-facing businesses, Lending Club, Prosper, Mosaic, et cetera. Generally speaking, those have been built out here. But if you think about what those companies have focused on, they've focused on things like origination, which is customer acquisition, which I think generally speaking, and generalization, but generally speaking, San Francisco businesses have done a better job figuring out how to acquire customers, particularly consumer-facing businesses.
Yeah, I really actually think it's pretty evenly split. The only two that I can think of is capital markets, which in my mind it's clearly a New York focused thing. And then for whatever reason, the 155 PFMs that exist out there today are all in San Francisco. And those are really the only two categories where I think there tends to be a really heavy focus. And that's actually probably a pretty good representation of, you have the really kind of heavy consumer-facing businesses here and the hardcore, capital markets and FinTech businesses on the East Coast.
Great. Then which coast or any geographical region, so we can include international regions as well, because I know you guys have investments everywhere. Do you think it's easiest to create a fintech company? And what are you exactly defining as easy, or what qualities are going to make the barrier to entry lower?
I actually think Europe is a really interesting place right now, just from a regulatory standpoint. The things that they've done with the sandbox, PSD2 is super, super interesting, and I think there's an entire ecosystem that is going to unfold.
Do you mind defining sandbox and get these things for?
Yeah, sure.
Sorry to interrupt, we're just gonna put more batteries in these. There's something wrong with the volumes going up and down.
Thank you.
Sorry.
Do we need the mic, or can you guys hear us if we talk loud?
Talk loud until we get these done. Thank
Great.
you.
So my voice is a little shot. Came
Never
off
mind.
of a 3-day wedding.
Is it yours?
Practice for my 3-day wedding. That's so Sandbox is an environment that the regulator can set up and say, you can try this widget that's putting, potentially, consumers in a financial product without having to abide by this huge regulatory framework that exists today, right? So go try this thing, let's see if it works, and if it does, maybe we'll adopt kind of a broader set of regulation that will support it. PSD2 is Payment Services Directive, the second version, which is actually probably like the 12th iteration or version of it, which basically mandates that FIs, financial institutions, need to give third parties, read startups, access to consumer data, right? So what that means is all these PFMs today that are scraping banks' websites and you're working with really poor APIs now have to work directly with those FIs to give them access to the data and build products on top of that. And once that connection is made, there's a lot of other products that can kind of be created inside of that ecosystem. So you've really seen the kind of European regulators do a lot of things right. I would argue some things wrong as well. But for a lot of those reasons, I think Europe is a pretty compelling place to start a business today.
Yeah, so I think, so the question, I'm going to repeat the question because I'm actually going to reframe the question. So question was, where is it easier to start a fintech business? Which region? I think before you even ask yourself which region, I think you should ask yourself, what type of fintech business do I want to build? That then probably helps define and drive what region you should be in, because when you think about building a B2B business, and if you're going to sell to a bunch of the big banks, just the proximity of being in a place can be super helpful. It doesn't have to be. Again, our portfolio company in Austin will do a lot of work in New York, but they often find themselves in New York even though they're not there. So just the proximity of being there and being close to the banks, being able to go to events, kind of meet the people at the bank, particularly when with B2B businesses, you're often doing complex sales with multiple stakeholders. You often have to win a bunch of different people over, constantly meet with them, and it's going to take probably 9 to 12 months to even go into procurement before signing a multi-year contract. I think just being there is helpful. So I think to kind of to that question, if you're going to build a B2B business, say, okay, where's there kind of a network of firms who I'm going to sell to? I think same thing if you're saying I want to build a B2C business, then you ask yourself the question, what drives that business? Is it customer acquisition? Is it user experience? Is it, do I need to end up partnering with banks? So then if that's the case, okay, where do I start and where do I end up? A lot of the lending businesses have started the consumer lending business have started in California, but then have hired head of capital markets in New York because they know that's where the bank buyers are for warehouse lines or securitization plays. Alex's investor in Mosaic as well. The head of capital markets is in New York, right? So they're a California-based business. So I think things like that, you just need to think about, what's the goal of my business, who's my customer, and then you can go from there and the regulatory regime. I think that's also a really good point. Europe's a lot friendlier than the U.S. in many ways, particularly when you think about things like digital banks.
Yeah, so I think at a high level, this is I completely agree with all this, which is basically where's the opportunity, and that might be in Europe, given some of the regulatory changes there, and then sort of where's the set of investors, talent, and customers that you are interacting with, and I think you should obviously consider that if you have sort of like a 50-50 or even just you're able to move. I will say that it is important to think about the personal dynamics here. Starting a business is impossibly hard. If you have a family, it's even harder. And so, both places, especially if we're talking about San Francisco versus New York, both places are good places to start a business, very expensive places to start a business. So maybe one answer is just neither. But other than that, thinking about what's going to be the best environment where you can, dedicate 100% to this without creating a huge amount of strain everywhere else in your life, because this is the type of thing that takes all of your time and effort. And if you're also, dealing with not being able to pay the rent, or because your family's across the coast, the entire coast, and that creates all sorts of other stresses that keep you from doing what you need or performing as well as you want, that matters a lot. Like, you have to enjoy doing this. And if it's going to make you miserable to move across just because, a big bank customer is over there, don't do that. Just, set up shop here. You'll have to get on a plane a little bit more often, but maybe that makes the most sense for you.
That was the best answer.
Great. Michael, you quoted a lot of companies, the advice that they get is to move fast and break things. But with FinTech companies, you recommend to move methodically and work with the regulator. So I wasn't very surprised with your Europe answer. I don't know if this is a question or a comment, or if you want to harp more on why you say to move methodically and work with the regulator.
Yeah, I mean, so it's our entire firm ethos, right? It's something that we talk about as a FinTech team all the time, and the biggest red flag in early meetings with the FinTech business is that kind of frame of mind, which is move fast and break things, and like, we're not going to think about the regulator. We're going to take the, I'm not going to name the company model and just, do things as we wish. It just doesn't work in FinTech, and you can go to jail for it. And as an investor, we don't like either of those outcomes. And I just think you see it over and over and over again. So I think from the very beginning, not only do you need a head of capital markets in New York, you also probably need somebody who's going to spearhead conversations with the regulator. And this isn't every single FinTech business, but there are a lot of FinTech businesses that are trying to change something, rightfully so. And proximity and relationship with regulators matter a lot. You need to be replying to RFIs and so on and so forth. And it's something that, as investors at Canaan, we've really spent a lot of time investing in with both current and ex-regulators to really kind of understand the current and rapidly changing with this administration, landscape, so that we can try to have a pulse on it for our portfolio companies. But it's absolutely the way we like our companies to think and the way we think as investors.
The other thing to that point, I think, Mike, is that you also need to think about how you want to construct your team. You may need to construct your team differently than in traditional startup. I mean, if you're a business that needs to get its broker-dealer registration or register with the SEC, you think about, okay, well, I need to hire a general counsel or a chief compliance officer a lot earlier than you need to with another type of business. And those hires are expensive. You probably want a senior person because that's what the regulators will want too. So it's just kind of different considerations around how you build a team from the early days too.
And if you're the CEO, you're building this company, the other thing to think about is how do you build the right culture? Because you're trying to navigate two things, which is, to your point, I 100% agree. You can, this is not move fast and break things, because this isn't like Uber where you're fighting at thousands of municipalities. Like, you're fighting one federal government or maybe a state government, which is much more powerful and much more inclined to shut you down entirely. So, but at the same time, you're paid for taking risk. If you're just going to act like a bank, then you're not ever going to innovate. So how do you create an environment where people understand what's okay and what's not okay, what's a calculated risk, what's an unnecessary and careless risk, and how do you have an efficient way of sort of validating those through compliance and having those right relationships to be able to actually innovate, as opposed to do one or the other extreme of being too risk averse or too risk taking.
Yeah, and I really can't harp on this enough, because you meet enough founders out there that are kind of surprised by this, and you really need to think about your own personality type, right? We did a lot in lending. I mentioned Lending Club, Orchard, Borrow, even Financial in New York. That's it's kind of federal regulation. You can get the web bank relationship and that kind of passports throughout all the states. Whereas something like insurance, it's still state by state, right? That just takes a long time, a lot of effort, and a lot of red tape. If you're the type of entrepreneur and founder, and there's nothing wrong with this, that likes to go out there and find out fast one way or another if it's going to work, you really ought to think about whether fintech is the right thing for you. I think there's no right answer, but you should really think about your personality type and the feedback loops that you need as a human being to go out there and build a company, because it takes a long time for a lot of these fintech businesses.
That's fascinating regarding the regulatory framework requiring you to, for instance, hire a general counsel earlier and then really focus on the culture and the risk. And what are the other things specific to fintech companies, early stage, that they have to consider that traditional startups, you mentioned Uber, for example, don't?
So I think for especially the lending and the insurance companies' capital raising strategies, they must understand. Traditionally these companies have been very capital intensive, which is why they have not made great venture businesses. And there's still an argument to be made that will continue to be the case for many of these. But figuring out a way that you can grow quickly, which is very hard, while not raising huge amounts of capital and diluting yourself and all the other early investors, is a very challenging thing. And we've seen models, a big part of the fintech innovation has been a function of these models arising where, you're an originator and underwriter sitting on top of a stack of capital, or, same both in credit and in insurance, frankly. But I think figuring that out early, understanding how much capital you're going to need, and who you're going to get it from along the way, and having some of those things lined up will make the difference between this being a successful business that can grow rapidly, or somewhere where you're going to sort of sputter out because the next step is prohibitive for whatever reason. So you really need to be careful about charting that path.
I think I'll take this from the B2B perspective. So I think for early stage company that's focused on B2B and selling their technology solution, their product to the enterprise, call it a financial institution, I think oftentimes these startups get so fixated on getting one big enterprise customer. They spend so much time trying to work with that customer. It might take, to Michael's point, 9 months, a year, even longer, get POC or get a contract. That in and of itself can sink a business if you're not planning properly, and what's your burn rate, and how long do you need to actually get that customer. How much validation do VCs or next round investors need to see with customer traction. So I think a lot of B2B startups, they end up focusing on working with one large financial institution. They're navigating through the process, and then somebody who is their champion leaves. And then they're stuck in a tough situation where that person may no longer be there, and may no longer support them, and the bank, for whatever reason, decides to go in a different direction. So I think for B2B startups, it's really making sure, understanding that yes, you need to get those first few big financial institutions as customers, but figuring out, okay, what's your strategy if you can't get that? Or how much time do you need and runway do you need to do that? So I think to that point, at least on the B2B side, I've seen a lot of seed extension rounds with B2B fintech businesses. And the reason why is because some of these companies have come through accelerators like the Barclays Techstars or a New York FinTech Innovation Lab. They have some early traction with customers, but they need a little more time to prove it out. So rather than go out and raise an A, they're not ready for that. They raise a seed extension round. Enough capital to get into the next 18, 24 months so they can actually prove that out. And I think you're starting to see that a little bit more in B2B fintech, just because financial institutions at this point know they want to work with and collaborate with startups, or build, buy, or partner. They're constantly going through that decision-making cycle. And I think as a result of that, you're seeing a lot of corporate VC participation. Last 5 quarters, you've seen about 25% of all fintech deals have had some sort of corporate VC participation. And you're also seeing these startups trying to figure out, okay, how can we work with these corporates, but they need time to do it. So you're seeing a lot of people step in and say, okay, how can I give them a little bit more runway to prove out that concept, and then when the Series A investor comes in, they can raise a round at a palatable valuation for the founders. They're not diluted too much.
Yeah, fintech companies definitely have a really long sales cycle. I want to dig in deeper at the CVC, the corporate venture capitalists that are investing in these fintech companies. Now maybe that some have progressed into future rounds. Do you see acquisitions from these CVCs? How do you see them contributing to the fintech companies? Do you think it's good for the ecosystem? Any overview of CVC's involvement?
Yeah, so to give a bit of perspective, I actually started my career at a CVC, started my career at Goldman on the principal strategic investments team, which invested Goldman's capital on behalf of the securities division, so investing in the companies kind of across the life cycle of trade, and have worked with a lot of corporate VCs, both at iCapital and then now with a bunch of our portfolio companies at Broadhaven. So I think a few things there. One is CVCs can be very good for B2B fintech businesses because they lead to an increased likelihood for those startups. So generally speaking, that can be a good thing because you get 1, 2, or 3 customers from having a few corporate VCs participate in the round, which can certainly lead to an acquisition later down the line if that's what those, what the intention of that CVC is. The other thing though on the other side of the coin is I think when you have CVC involvement, you need to be kind of cognizant of what that means to your cap table and what that means to your business. What it means to your cap table. If you have too much corporate VC participation, not enough financial VC participation, then that might mean it takes longer to get certain documents signed, certain rounds closed, big decisions made, because all these corporates, they have their own processes for kind of prosecuting a decision, their own processes for deciding how to deal with other competitors. I mean, some of these fintech companies will have multiple, you're seeing rounds with kind of multiple insurance companies that are both participating in what they seem to kind of to deem as an enterprise or kind of a industry-wide collaboration. So I think you just, as a startup, have to be cognizant of that, and even as a financial investor, you have to be cognizant of that too, because do you want too many corporate VCs around? Maybe not. But I think all in all, it can be a good thing if you manage it properly.
Yeah, I think I have 2 points on that. There are very good corporate VCs and there are very bad corporate VCs. So do your homework, talk to some more people. None of us are going to tell you who the bad corporate VCs are here, but you should find
Turn
out.
the camera
Yeah. And what is a bad corporate VC, right? What can they possibly do? I think what happens is they slip in a lot of terms and they will participate in fundraising rounds where you may be having trouble raising a little bit more money, and they will slip things in like ROFR on M&A, for example, which is probably potentially the worst one. And I can tell you as an M&A advisor prior to being an investor, it absolutely exists, and it's the worst thing, even as an investment banker. And I'll tell you, as an investment banker, we do everything. If a company had that term in their financing docs, we would even think about not doing it because it can be such a negative signal. And the reason for that is it's the same reason why if you had 5 investors in your seed round that can all lead the Series A and none of them are leading it, as a new Series A investor, I'm immediately saying, well, they know something I don't know, so I'm not going to touch it without even doing any more work because it's like clearly somebody would have done it given the opportunity. And the same exists for M&A, right? If they're not doing the deal with that term, there's something that the buyer probably doesn't know.
Yeah, I would just add a couple more points here. So agree, there's a lot of benefits, and there are some really great corporate VCs. There's some that are worse. Learn about how long some of the worst ones take, especially if they need to get a ton of business unit approval. That could be a multiple month-long process. And they might still be great, but start that process early. I would avoid any situation where you're having a round that's led by a corporate VC. One, because of the terms, and we actually have had a company in our portfolio that had a ROFR and that ended up going exactly as you described. There was exactly one buyer for that company, and that buyer set the price. It was a good outcome, but it was not a venture scale outcome. And then the other thing that I will say here is, we all talk to insurance companies and strategics in this space all the time, and every now and then, I would say this not often, but every now and then you'll hear, so this other company's invested, I'm not going to touch that company. So sometimes that will close you off to customers, and there's certain industries that are going to be more competitive, or there are going to be certain pairings of companies that are going to be more competitive, where that might preclude you from getting a customer relationship that you want. So do your diligence there before you take money, because agreed, it could be very useful in certain cases in opening doors.
I'm going to segue a bit to blockchain and FinTech, which cryptocurrencies right now have been a very popular trend. Then pulling it into first geographically, do you see more cryptocurrencies East Coast, West Coast? How has it been with them raising ICO rather than traditional venture? Alex was talking about you guys are investors in Ripple, so if you could talk a little bit about that, that'd be fascinating.
Yeah, absolutely. Yes, we're proud investors in Ripple. They're one of the sort of earliest examples of an ICO, really. And I think what they're doing is quite special. They're a cryptocurrency and building all sorts of specific functionality for the global financial system, which is a little bit unique in the crypto world. You know, most of these things have been built sort of as raw platforms for people to take advantage of, and I think there's a lot of benefit to that. Ripple has been purpose-built for global financial institutions, have a ton of traction. I think they have like 100 institutions in production or something like this, and some of the biggest banks in the world. I think one of the interesting things about blockchain is that it's exactly not about it just SF in New York City. It's really about democratizing this and letting anyone build this and letting distributed teams build this. Now, I think have yet to see a ton of big, fundamentally strong businesses built yet, but certainly the potential is there, and especially with ICOs, that potential is is exponentially more present. And obviously, everyone sees the allure of that, especially if you're a founder. In terms of blockchain, I think we do see there's still a little bit of this, like in the crypto world, there's still the anointers of crypto companies, and I think there's a good deal of them all over the world, but I would say a bunch of them are here, especially on the West Coast, both in LA and San Francisco. There's some in New York, but there's a little bit of this kiss the ring phenomenon going on. If you want a successful IPO and who's your advisor and who's behind you, I think you can be anywhere, but you've got to make the trek out here and do the whole rigmarole.
Well, it feels like every company should do an ICO these days, doesn't it?
Why not?
I know, right? You get free money. No, joking aside, so I think a few things on the cryptocurrency and blockchain space. So I think there's a few ways to think about this. One is how will there's cryptocurrencies themselves, which have generated enormous financial returns for some people. As a result of people building protocols, people investing in those tokens or holding tokens on top of those protocols. And I think that there's actually a whole aspect of FinTech there in the sense that there will have to be a whole crypto capital market structure that's created. Just like financial market structure in traditional equity markets, fixed income markets, there will have to be some sort of market structure created. It may look a little different, but you'll probably need all the similar building blocks of, okay, what does the life cycle of a trade look like? Where's the KYC, AML? Where's the custodian? Where's the exchange? And people are building a lot of different things there. So I think that's kind of one aspect of blockchain FinTech. Then I think you have traditional financial market structure, capital markets. Alex, you alluded to it with something like Ripple, where you're building kind of private permissioned blockchain solutions for existing financial market structures. So how do you think about clearing and settlement and using the blockchain or distributed ledger to do that? I think that's another aspect of blockchain that's interesting, and I think the question there for me is, will those businesses be good financial investments for financial investors, or will they be better as industry-led consortiums? And if you look at a lot of the exchanges, clearinghouses in traditional financial markets, a lot of those businesses are generally invested in by banks, who for them, very good investment because it's helping them do their business better, it's helping them reduce their trading fees, building a market structure that works for them. But as a financial investor, you kind of have to ask yourself, okay, does it make sense for me to invest in a private permission ledger? And in some cases, I think Ripple will probably end up being a good outcome. But you see a lot of businesses that are being created in this space where we'll see what the outcome is, and we'll see who the participants end up being. Should they be banks? Should banks be building these solutions for themselves? Digital Asset Holdings is one that comes to mind. They're building a kind of a settlement process built on the distributed ledger. A ton of money invested in that business. Will that end up working? Would it be good to be a financial investor in there? And then I think the third kind of area, which is interesting and impacting both VC and FinTech, is are the cryptocurrency funds. I don't want to call them hedge funds yet because I think they're mainly long only. But how does that impact the ability for companies to raise capital? And as a result of that, how does that impact what it means for venture capitalists as a business. So I think that's another interesting development in this space. If companies can raise money through an initial coin offering, which means no equity given up, no governance, why wouldn't a company do that? There's a whole host of reasons why many companies shouldn't, but some companies that are mainly kind of network effects businesses, it makes sense for them to do that. And what does that mean for traditional VCs? So I think that's kind of, when I think about kind of blockchain, fintech, how they all intersect, those are the three areas that I think about.
So I think blockchain technology and crypto in general is a fascinating technology, and I think there are going to be a lot of very valuable applications that are built on top of it. With that said, I think the noise to value ratio today is higher than I've seen across almost any vertical throughout my time in tech. And I'd also say it's a classic case of move fast and break stuff. A lot of people are doing things with these technologies and really not thinking about the fundamentals of what they're building. You talk about AML KYC. I'm on the board of a company called Beam Solutions that does AML KYC, and it's just an afterthought for a lot of these companies out there that are going out and raising a lot of money, and it's a very real thing. Right. You talk about, again, reasons why people go to jail and get fined.
They don't even do KYC.
Not exactly. Most of them don't know what the acronym is. And so that really just kind of terrifies me and makes me want to just completely back away from the market until some of that settles down a little bit. Again, with that said, I think there are a lot of companies that are doing some really, really fascinating work. Ripple being one of them. I think it really is truly a differentiated and unique solution in the market today. So I'm very hopeful, but I would also just caution you guys to do a little bit of work before jumping into one of these.
Yeah, agree. And then a few thoughts on ICOs, and this is not just. I think there's definitely a question about what this does to VCs and what happens there. I happen to think that generally the world trends towards division of labor and specialization, so there'll always be some sort of VC. It might not be us, it might be but there'll be someone. And you sort of forget that we're in a world where the consensus is individual retail investors shouldn't pick stocks. They should invest in betterment and Wealthfront. And then in early stage stuff, we're like, VC should get out of the way and let people pick the riskiest startups, free product, and invest all their money in it. And it's sort of funny to see that dichotomy that so far out on the risk curve, everyone is saying let's invest in ICOs, and then all the way out where the companies are actually safe, we're saying no, let's get into an ETF or an index fund or a robo, and I think those need to be reconciled somehow. Second piece I'll say is, the idea of a seed stage company or early stage company going public is not new. It's just new in America recently because it's very hard to go public and it's very expensive. We had a company called TO Networks in our portfolio that was actually a Canadian company, although it primarily served the US. They went public basically at the seed or Series A stage in one of these sort of alternative stock exchanges in Canada, and that's not an uncommon occurrence. It's not just for penny stocks, and the regulatory burden there is much lower. And that had a lot of pros and cons, in all honesty. But and it actually, I think, helped the company a lot because they actually ended up having a currency they could use to make acquisitions, which is a pretty unique thing for startups. That there's sort of a mark-to-market currency that you can go to a potential target and say, we're going to not just raise equity, we're not going to raise debt, but we're going to basically issue shares that are worth a certain amount, and we're going to buy your company. That was very powerful for them. On the other hand, we have not even begun to talk about the issue of liquidity for startups. And one of the reasons that people are, sort of ostensibly like venture capital is that we have 10-year fund life. The information is private. We're supposed to be patient investors, and maybe sometimes we're impatient, but we're certainly more patient than your average hedge fund investor in the public markets. And so we haven't even begun to scratch the surface of governance and transparency and information. But if I were a startup, obviously if you can raise $200 million without diluting yourself, that sounds like a potentially great thing to do. But let's say, all else being equal, if valuations come down and become more realistic relative to the promise of the startup and the currency and the token, I think you have to ask yourself, how do you create a structure where you're not revealing information every quarter and having the exact same dynamic that you have in the public markets, which everyone is desperate to get out of. which I see, without changes in the ICO structure, that's going to happen eventually for all those that choose to issue a token.
Yeah, well, one follow-up to that comment about, what is kind of division of labor between, will VCs, do they have a reason to exist? And then to tie that to your comment about, what does things like governance mean in this space? I wonder, it's an open question, but I wonder if you see things like pre-sale tokens. So there are investors who add value who get in at a discounted price to then a public token sale, which is kind of like a quote-unquote IPO to some extent. I wonder if ultimately, maybe governance means different things than it does now with venture capital firms investing equity into startups than it does with ICOs. But I wonder if there will be some kind of some modifications on governance and some of these companies who are raising ICOs or go to the crypto capital markets to finance themselves, if they end up wanting to have VC involvement because they can add value, because they can help provide direction. In some cases, VCs can be very helpful in those ways. So I'm curious to see how that'll work. I think the other thing too about this space that I think makes it very interesting is one, I think that there are certain transformative aspects of this. I mean, the concept of decentralized computing and what that means to be able to actually invest in a protocol, in the protocol layer of a technology and actually benefit from that. Whereas we previously kind of, and generally speaking, select few have been able to invest in the application layer of things, like think about Amazon, Google to early stages, who's investing in that, generally venture capitalists. But to invest in the protocol layer, I think is transformative. I think there's something there, a long way to go. But what I think it certainly has done, at least for me as a venture capitalist thinking about different companies, when I evaluate, what company makes sense to invest in, I now ask myself, okay, this business is not using the blockchain or distributed ledger. Should it be? And are there other companies out there that are doing that? And then if they're not, what does that mean for this company over the next 5 to 10 years? So it's made me kind of refine how I think about businesses. I kind of have to think, okay, well, what does this mean for this business? What does this mean for future state? Can a business be created on the blockchain that's doing the exact same thing and totally change the way we think about it?
Yeah, it's extremely exciting using blockchain and outside of FinTech and in a variety of industries and all of the various applications it has. Well, Alex, Michael, thank you guys so much for such a wonderful conversation and answering all of my questions. I'd like to give the audience an opportunity to give the panelists a hard time as well. So does anyone have a burning question?
This is actually just a follow-up on what you said, which is really compelling to me because it seemed like last year at this time, maybe an institutional investor, venture capitalist would have said to a company that's, FinTech company using blockchain to perform some use case, like, what's your use case? And they really drill down into it. And now you're actually speaking it from the other point of view. Why is that? It's because there's more flexibility to blockchain-based technologies. What is it that has caused that shift in thinking?
Just want to make sure I understand your question. When you say the other point of view, what do you mean by that?
Last year, most VCs investing in blockchain or even entertaining the idea would have asked the entrepreneur, do you really have a use case for blockchain or just using it because it's sexy and a way to raise $2 million?
So I think that still holds true. I mean, when I say that, I think, okay, is there a blockchain use case here? I think there still has to be a use case. Like things like KYC, AML, there are companies trying to do that using the blockchain distributed ledger. Sure. Like Civic being one of them. So I think, I'm curious to hear your thoughts on, does that maybe a different KYC, AML business, but I still want to see a specific use case of, okay, this is KYC, AML on the blockchain. Is this done better, more efficiently than a non-blockchain based or distributed ledger business? So I think it still holds true. I think you just now have to really think about that.
Well, maybe it speaks to who you are as an investor, willing to help the entrepreneur out a little bit by making use case.
Yeah, and I think I'm more than happy to.
So if you were to run a filter pass over the last 10 years of your operations and look at all the entrepreneurs sort of stacked up in a big old bunch and look at all of the instances where you have had frustration with those entrepreneurs on a per constituent basis, and then times the sort of number of the frequency of frustration with the magnitude of frustration, which do you think would have, which kind of flavor of frustration do you think would have the highest score?
Wow. Carry the frustration. I think, So it's I remember when I first got into the business, you talk, what makes a good investor, and it's investing in people, right? And it totally is true. It's very cliche. But the reason for that is because I think the biggest reason companies fail is because of people problems as opposed to product or market or things that are, presumably in your own control. I think most commonly you see founders who want more power and or recognition, both inside and outside of the company. And you can probably group those into, just one category. I think those happen more frequently across businesses, and it doesn't just have to be founders, right? It's bringing in a new VP and they're not getting along with somebody inside the org, so on and so forth. But I think, really not surprisingly, just human nature, people really looking for the satisfaction of kind of recognition in some of the wrong ways. I think you just really need to think about the culture, about around the business that you're building, because that stuff matters and it destroys a lot of enterprise value.
Yeah, I think that's the other way the other like vector through this is I think founders need to be incredibly self-aware, just like VCs, and we need to be constantly staring at ourselves and saying, what can we do better? And I think the best VCs, the best founders are always doing that, and they're always saying like, what's the best thing for the business? What do I need to add? How do I augment myself? And to your point, the founders who are just looking for power or control, I think obviously we all, to some extent, we all want some control. But I think if you're thinking about sort of broader and what are you trying to build and what is the enterprise and the legacy that you're trying to leave, and being open-minded around what you might need around you. That doesn't mean that you stop being CEO or you give up your job, but how do you create the right environment and the right culture where you're creating leverage for yourself as opposed to just controlling the enterprise.
Yeah, I think on that point, especially in something like FinTech, where there's so much specialization often needed in order to build a business, you're never going to know everything. So generally speaking, if a founder ends up hiring people smarter than them, that's kind of what you look for, and you need that operating leverage. You're going to be founding something you're passionate about, building a business in a specific area that solves a specific problem you had. That's awesome. Then go out and hire people who smarter than you, who know that specific area, whether it's sales, product, engineering, better than you, and you give them the leverage to do that. And you're still the founder. You'll still end up getting all the credit, even if you don't have to kind of raise your hand and say, I'm going to take that credit. I think the other piece of that too is, look, there's all different times which kind of makes sense for a founder to play a different role. But I think having that self-awareness to know that, and kind of think ahead too, and say, okay, you know what? I know I might not be the right person at this point in time for the company, but having that self-awareness to be able to say that and kind of voice that kind of, at the right times to the other members, the management team, the board, et cetera, just so you can kind of start to think about that and say, okay, like how do we get this to the next stage? I mean, VC is and building a startup is very much a milestone-driven business, right? How do you get from this milestone to the next milestone to the next milestone? So just having that awareness of kind of when and how to say, okay, like I've built something, this is awesome. Bringing in the right people to do that, I think is super important.
Continue the blockchain discussions. This is topical. But on the ICOs, even China banned ICOs, and you see the SEC taking more aggressive stance to do something like that.
Yes. Yeah, absolutely. I mean, if you look at the tests that that you should be considering whether something is security or not, one of them is, do you expect a profit? And it's very clear that most of the people who are buying tokens today are expecting a profit. That doesn't mean that ICOs are going to go away. That just means you're going to need to have more infrastructure around them. There are obviously issues, but you can do all sorts of accredited investor checks. You can make sure you're limiting the sale of tokens to other accredited investors. So that doesn't kill the entire ecosystem. I think there might be a potential issue where is the capital and what's driving all of this? If a lot of this is basically money trapped in China that's trying to get out, and they're trying to diversify away from just Bitcoin or Ethereum or whatever it was they mined many, many years ago, and then they're just diversifying to tokens to try to get out of China, and China is effective at cracking down, then you might have a real problem with the entire market.
You also have a lot of founders of these protocols who have significant amounts of capital, whales, who want to diversify. So that's why you're seeing, I think, ICOs, they want to diversify into other tokens so that they can end up kind of diversifying that holding. I think one other point on that, which is interesting, and I'm interested to see how this will play out. But to your point earlier, Alex, I mean, you said people are investing in tokens, which are in many cases incredibly speculative, and the volatility on some of those tokens in terms of how much can go up and down in a day. I mean, Bitcoin's gone up and down $1,000 in a day due to kind of news and things that people have said. So I'm curious to see when the SEC will kind of go the way of crowdfunding with like Reg CF, where unaccredited investors can invest into startups, but do so in a prudent way, where they're only investing a certain portion of their net worth every year. They can only invest a certain amount of money onto any given equity crowdfunding platform or into equity crowdfunding companies in a given year. I think that type of thing would be prudent for cryptocurrencies, because people can invest however much, and it's kind of like right now it just feels like people can go to a casino and gamble, and in some cases they'll make money, but in some cases they'll lose.
I think we have time for one more.
Sure. So as an entrepreneur, how would you evaluate venture capitalists, specifically investing in your company, related to like the quality of investor, the type of thinking, and the people that you want to be partnered with if you're a blockchain company looking to work in fintech?
Two separate questions there. The first one, just how do you pick your VC? Just back channel them, like really aggressively through inside of the portfolio, and just really try to back channel and find out, are they the board member that's on their cell phone half the board meeting or not, right? Are they the investor that's really kind of going about for you and actually doing work for you? Those are easy things to find out. So don't be shy about talking to other founders. Founders like talking about the VCs, and at least in my experience, are more than happy to. And by the way, if you can't get a founder on the phone, for the purpose of talking about their VC, that's probably a pretty telling sign. So I absolutely don't be shy about that. And then the second piece was if you're starting a blockchain business, and I think look, there are very specific relationships for fintech, and so I would just say go with a firm that has really kind of invested in building a brand and a set of relationships there, because I think particularly on the regulator side, I would say regulator and corporate, depending on what you're doing with the application, it's immensely valuable and important, and those are tough relationships that just kind of sprout out of nowhere.
Yeah, I mean, I think to add to that, one of the reasons that you see all of us sort of specialize in fintech is because fintech is a little bit of a different world. Blockchain is a different world as well, and sometimes they intersect, and you might find someone who's a fintech VC that's a perfect fit, and sometimes you might not. But to the point about what are founders' pet peeves or whatever, and talking about self-awareness, I think that's true, very much true of VCs. And one of the things we think a lot about is where are you going to be like individually useful versus where is our network going to be useful, and what do we know versus where is someone else going to be a better help or expert. So we always like to say you're sort of the race car driver, we're the pit crew. And what we spend a lot of time doing, and I think what my colleagues in the panel do as well, is spend a lot of time building our network outside in the corporate world, in the incumbent world, because we know that that's going to be where the expertise and the help is going to come from. It's not going to come from me sharing my opinion about how you should do whatever technical thing you're trying to do. Now it's going to be some knowledge of someone, an introduction for someone who's going to be able to help you with that, or an introduction to a customer, an introduction to an advisor. We recognize we don't have all the answers, and we're going to leverage our networks to help. And I think in fintech specifically, with the regulators, with the specific banks and insurance companies and pools of capital, that's a very specific network that takes a lot of time and effort to build.
Plus one to all of those comments. The other thing I'd add too is, as a founder, ask yourself, what do you want the outcome of your business to be, and then match that to the fund. So say, okay, is this fund, what is this fund's outcome looking to be, and ask the VC those questions too. Ask the founders, the other founders who you do references with, what's the VC's expectation of this, if the outcome if they invest in this business, because that's really important as well. Is you want to be aligned with your investor. You're going to be quote unquote married to them for hopefully 10 years, maybe longer if things either go well or don't go well. So you have to kind of have alignment on that, and alignment on what you want the future of the business to be too, because VC is a milestone business. then they're, that VC who invests in the current round is going to help pick the investor who invests in the next round. And you want that investor to be aligned with the previous investors and what your outcome is as well. So I think that's super important in terms of thinking that through.
Yeah, so the last thing I would say is, sometimes you just have to raise money, and if you have one term sheet, take the term sheet and take the money and go build your business. You have to do it. But if you can choose, I think it's also really important to just think about that person. Do I want to go get a beer or a smoothie or an ice cream or whatever it is that you enjoy after work with this person? I personally think about that a lot, and I'll sometimes meet founders, awesome business, really interesting. I don't know that I can potentially sit in a boardroom with you and dinners and so on and so forth for the next potentially 10 to 12. We have a company in the portfolio that has been there for 24 years. You always want to aim to exit a little bit quicker than that. But I think that's very real and something to think about.
Thank you.
Well, thank you all so much. Can we give our panelists